Completely acceptable. We don't worry about those things. The market shows a willingness to respect the inversion fair value gap, and then breaks lower, institutional order flow entry drill. And then we have this wick, big wick here, okay, which doesn't do much in terms of damage below this low for sell side. So once we move through it, I liked this gap, but I wanted to refer back to this wick. So does this market respect that wick's consequent encroachment? I don't know. Does it? It's perfect, isn't it? Look at these candles here. The bodies tell you the story. The wicks, they do the damage. And this is telling you narrative. It means the algorithm is in a sell program. It's going to seek sell side liquidity. It's going to run on sell stops. It's going to run to inefficiencies. Well, there's a small little inefficiency remaining here. It gets down to it there, comes back up into a small gap there, and then does what? Dives for the sell side and gets below the weekly TGIF 20% of the weekly range. I went short on here, trading inside of the idea that we are in this inversion fair value gap there. I took a little bit of heat on it, but not much, and then aggressively ran for the sell side, and there you go. So that's what I used to teach my son on Friday afternoon. Notice where we closed. Look at this. Real close to the 20%. Again, you don't find that in your books, okay? There are so many things that people will look at, whether it be me or other people, and because we're looking at the same four things, the open, high, low, and close, we're forced to use geometric shapes, okay? We're forced to use trend lines and things to articulate, an idea with a audience member or for our own journaling. And when we make these things available to other people, invariably they're going to see, oh, well, you're doing the classic this and the classic that. I'm not doing anything that's classic. I'm making the new classics, okay? I'm making the new future reference books, okay? Everything that you're learning here live, you're in that Gann moment, okay? You're in that Livermore moment. You're having someone teach you something that no one's had their fingerprints on before. And I say these things not to be arrogant. I'm not trying to be condescending to anybody. And I'm not saying to hear myself talk. But I want you to appreciate the fact that what you're being exposed to, you're not entitled to it. You're not entitled to know these things. So when I see other people claim they know it, claim they've been doing it before me, they have no experience doing it. They have no track record with it. They can't even go out and do executions to prove they don't even know how to do it right now, let alone say they did it before me. So I want you to think about what you watched happen last week, how explosive the market moved, exactly how I outlined it last Sunday. Before the market opened up, you had it in your hot little hands. What do you think your trading would be like 2 years from now, learning this? What do you think your trading's going to be like 10 years from now? What do you think your trading's going to be like 3 decades like mine today? My understanding of the marketplace is rooted on things that I've codified in 1996. So the things I'm talking about and teaching, I authored these things. No one taught me these things. No one mentored me. No one sat down and said, here's my mentorship, join this, and I'm going to teach you that. It wasn't in any of the books. It wasn't in any of the things I bought. And it's not easy. I know it's not easy. You're learning it from the person that created it. And it's a struggle sometimes for you to learn. And it's not because I'm not that good at teaching. It's just this is a very dense topic. It's very, very, very dense. It requires a lot of study. It requires a lot of case studies where you go back and look at old news and you study it. And you listen to the boring stuff I talk about, whether it be in a Twitter space or whether it be in these parts of the video where no one really likes to listen to it. But you're not going to learn it without having these things. And that's what mentorship is. If you want to sit down and learn something from somebody that knows something very well, and if they really want to teach you, they're not going to rush through the topic. They want to make sure that they get into all the nooks and crannies. They want to get down to the small little things that are going to creep in and mess you up because you're going to make a big mountain out of something that's not that significant. And I know what those things are going to be. So that's the reason why I talk to you about these things. Don't focus on that. Focus on this. Do this. Don't do that. And for the folks that want to speed through it, and try to do, an abbreviated mentorship, you're the one that is going to fail. And I have a lot of failures because they rushed through it. Not because the content doesn't work or the concepts don't work or I can't teach it properly. But there's going to be a huge learning curve for some of you. And others, you'll pick it up faster than someone else might. It's just a matter of personal experience. And each one of you are going to have a duration that is unique to you. And you have to submit to that. I'm a practical person. I know that not all of you are going to be able to resonate with me. I'm not going to scratch the itch as a mentor for all of you. And you're going to want to chase something else. I promise you, folks, I promise you, I swear to you that there is not one single person on YouTube or anywhere else that's going to teach you like I'm teaching you. I promise you that. They're just familiar with what I've already shared thus far. So there's nothing wrong with looking at other people's level of understanding. And that's what they're doing. They're showing you their level of understanding. But they're not in a position of authority to be able to teach it because they don't even know what they're teaching. They're just familiar with it. And it's just like when you first got a driver's license and you handed, or your parents handed the keys to you, and you get in and you start it up. Just because you have your driver's license doesn't mean you understand exactly how that car is designed. What causes the ignition? What causes the engine to stay running? What's all the connections that causes all of these instruments to work like they do? You probably didn't do much thinking in terms of that. You just couldn't wait to get behind the wheel. And that's what these mentors, and that's what you many times as a would-be student is like. You want to rush out there and just get your hands dirty with it. And sometimes it ain't dirt, it's blood. You lose a few fingers, maybe more, because you're rushing in before you're ready. And you're learning from people that don't know what they're doing. It's easy to talk about it in hindsight. It's easy to use what I'm talking about in real-time analysis and then borrow my viewpoint on the marketplace and then come out and say, look at my students that passed their evaluations. When if I wouldn't have said anything, you would have had no voice and your students wouldn't be doing anything. So I'm going to leave that with you and remind you that these things aren't cherry picked. These things are not coincidence. They happen every single week. And sometimes there are certain parameters that are met that allow for explosive runs. What took place? What took place this week? Think about it. What's occurring on the daily chart? Fair value gap. Boom. Third week of what? Third week of what? June. Just like that seasonal tendency calls for. Folks, those things are like roadmaps. And we knew in May, when the seasonal tendency that I like to see, where if it sells off, if I can find something technical that aligns with the market to see it go lower, if it's not providing that, that means we are really bullish. S&P went up over 400 handles. Look at the NASDAQ. Almost 1,000 or more. From this turning point right there. And then rips again in July. This move right here, this is a classic in the summer months. That's a classic scenario. If you're in a bull market, this is what you expect in the months of June and May. If we're in a bearish market, a sell-off in May into June, they're very, very good. That's how you use seasonal tendencies. The idea or premise behind a seasonal tendency that is failing and being instrumental to having a market go explosive, in the opposite direction to what the seasonal tendency would imply. I learned that from Larry Williams. And I learned that in 1995 from his 4 VHS tape. I mentioned it many times over the years as a resource that I learned from, and I believe it's titled "The Future Millionaire's Confidential Trading Course." And he talked about seasonal tendencies in there. He talked about how he was the first one to write a book about seasonal tendencies. And he talked about Jake Bernstein, who I'm not a fan of. I never liked his work, even though Larry himself respected him. I didn't. I didn't find anything of value from him. Okay, and I'm sure there were people that found usefulness from whatever he put out. I just personally wasn't able to do that. But in terms of seasonal tendencies, the idea of when a seasonal tendency is failing to manifest itself, that is many times, not always, but many times, it is conducive for an explosive price run in the opposite direction to what you would expect in the seasonal tendency. So because we had the potential sell off in May, didn't form. It did not form at that time. So that gives more rocket fuel for the June low that forms, and that's classic in stock index futures. So as a swing trader, I'm saying all this stuff to you because I know there's some of you that don't want to day trade. You can't do it. You don't want to do it. Doesn't fit your personality, and I understand that. But what I'm showing you here on this daily chart, how's that any different from what I'm teaching you on a 1-minute chart, 4-minute chart, 5-minute chart, 15-minute chart, hourly chart? It's nothing different except for the time frame. Isn't this something that we would be looking to get long on anyway if we're bullish? Yes. What is this here? High and that high. That's relative equal highs. That means what? There's buy side above that. We're not looking at that as going back up to this here as resistance. We're looking for it to trade through it. Does that sound like resistance to you? What kind of resistance would that be? If you thought that this was a resistance level, these relative equal highs, you thought that same idea was the same thing you would hope your roof on your home is like. Would you want a roof that performs like this? No. So I attack and I teach my students to attack buy side liquidity above a single or relative equal high. I teach my students to attack a single low or relative equal lows where there's sell side below it, to it and through it. That's what we teach here, okay? We do not teach some garbage resistance and support idea that is so ambiguous. You have no idea that there's never been a book. I'm telling you right now, I have over 2,000 books, and there has never been an author, educator, teacher that has ever codified a single approach that goes in and finds the right support and resistance. It's not there, folks. That's a religion. That's what it is. It's a religion. Okay, they say we're a cult. The idea of support and resistance, you have to have more faith in that than simply understanding that what I'm teaching here is the real market, because it's subjective. No matter where you are in the world, if you're pulling up the NASDAQ daily chart, you're going to see this gap. Okay, it's a fair value gap in the form of a buy side and balance, sell side efficiency. That does not hide from you. There's not other ones in this area that you might get tricked by. But the idea of picking a support and resistance idea based on classic support and resistance theory, what high are you going to use? What low are you going to use? What diagonal trend lines are you going to draw to? And which one's going to be correct? See, I've wasted lots of money doing that stuff. And so have you. Other people that have traded before I was even born wasted and lost lots of money doing that stuff too. But hey, it looks great in the books. It looks great in hindsight. Look at this level here, this diagonal support, this diagonal resistance. And I went in and I created a concept that attacks that idea, that entire premise. I attack it. And that's my phantom trend line. It's a specific approach to going after retail thought processes about that very idea. I've taken retail and turned it upside down, and I've made it useful to anyone that simply wants to look at it, investigate the ideas, and see if, whether or not I'm telling you the truth. And if you go into charts, I promise you, you're going to find that truth and that proof. There's so many people that are students of mine now. There's so many students of mine that used to be detractors, doubters in the beginning. They want to go in and prove that what I was saying wasn't the case. And now they're long-term, loyal students. They know what they have learned from me is the truth. And you're seeing that. You just saw it again. How can you cherry pick the entire weekly range? How can you cherry pick the entire weekly delivery of not just one market, but 4? I gave you Forex, I gave the dollar index, and I gave you the ES. It delivered like gangbusters. And you should be excited about that. Not hopped up on goofballs, but you should be inspired by it, thinking, "Oh, well, this is really encouraging for me. Now I have something to go on," because everybody that watched that video on July 9th of 2023, that analysis video, that commentary that I gave in terms of what I felt the market was going to do this week, it's on YouTube. It's available to everyone. You didn't have to pay for it. You don't have to do any kind of subscriptions. You don't have to send me no money through PayPal. You ain't got to do any kind of crypto payments, which I wouldn't take anyway. All you have to do is watch the videos, take notes, and share your experience with me. That's it. It's free, folks. And there's people out there that simply want to keep you from learning how to do this. And the more closer we get to November, it's going to increase. Because nothing else you're going to learn can compete with this. Nothing. I promise you. I promise you. There is nothing like this. Because this is the truth behind the marketplace. This is exactly why markets go up and down. It has nothing to do with the depth of market. It has nothing to do with market profile. It has nothing to do with supply and demand. It has nothing to do with Elliott Wave. It has nothing to do with harmonic patterns. None of that stuff is what causes markets going up and down. There's no such thing as buying and selling pressure. There's buying and selling going on. I'm not arguing that. But when the market goes, it's going to a very specific level, and I'm teaching you what they are. I'm telling you when they're going to do it. There has never been a phenomenon like what you're experiencing right now. And I'm honored. I'm very honored to be sitting at this helm with you as your mentor at a point where I have 771,000 students on this YouTube channel now. That to me is bonkers. It's crazy that there's that many people wanting to sit down and listen to a guy from Middle River, Maryland. So I'm definitely blessed. The Lord has definitely made me the head, not the tail, and I'm greatly appreciative of all of you that want to sit down and spend time learning from me. Until I talk to you next time, be safe. Okay, folks, welcome back. All right, so we are looking at another discussion and lecture on institutional order flow. And before I get into it, I borrowed this from another YouTuber. It's not important who it is, and I'm not saying that there's anything inherently bad about the other YouTuber. I'm not trying to sow discord or anything like that, but I do see a growing number of you in the comment section and folks that email me or reach out to me through TradingView, the idea of order flow using a DOM, which is a depth of market, which is over here on the left-hand side. Then you have the footprint, which is in the middle of the screen here. See all these little, look real technical, right? That's institutional. And all this down here, wow, that really makes your chart look amazing. When I was younger, I would have loved to have added all that on top of every other indicator I had on my chart. Okay, because it would have made me feel like I was smarter, more informed. And I want you to think about what it is that you're learning from me. Okay, if you're new or if you've been with me for a little bit of time, it can seem a little daunting, a little complicated, if you will. And it's because you're trying to rush through the process. And if I were to ask you to look at this, here, look at this information. What should you do with all this? Now, I know how to use this information. I know how other people use it. And I have friends and I also have students that use things like this in concert with what it is that I do. And they are profitable. So I'm not trying to discourage you from using these tools, because if you feel like it helps you, if it's advantageous for you, it helps you trust your model. Everything I'm saying here today If you feel uneasy watching the video, just turn it off. Okay? I'm trusting that you're all adults here. You can see through what it is I'm trying to convey. I'm answering the question of, do I see the necessity for these types of things in trading? And in the short answer that way, for folks that want to know right away and not waste any more time, I don't believe that it's necessary to know these things. In fact, I'm going to talk about why these are no different than any other indicator out there, because it's a faith-based premise that has to be applied to everything, whether it's my content, my concepts, somebody else's stuff, or even this. You know, institutions that may subscribe to these types of things here, it doesn't make prices go up and down. The only thing really you're doing is with the left-hand side over here, the DOM, depth of market. When you see orders coming forward on that display, they can be spoofed. Okay, spoofing is where an order can be placed above or below the marketplace and pulled away before the market prints it. And it'll make it look like there's more buying or selling interest in a particular market. So how would that be any more advantageous or different, really, for a trader that has to sit down, look at the market, and determine it's going to run from where we are right now at the market price to some previous support level? So in other words, you expect it to go lower, or it's going to go higher to some previous resistance level. Okay, so you're still met with that same challenge of knowing what you need to know, where the market's going to go. Okay, and there's so many people out there trying to be educators, trying to be an influencer, trying to convince other people they can trade. They are stating these terms here. You don't have to predict the market. You don't have to know where the market's going. And this to me makes absolutely no sense. Okay, it makes no sense whatsoever, because if you're looking at the depth of market over here, and the idea is that you think that there is a more likely, okay, this is what you're going to have to subscribe to using these types of tools. What's more likely? That the market will start to go down to eat into the orders that are below the marketplace? Or is it more likely to go higher to eat into the orders that are above the marketplace? Well, I'm not concerned about those small little fluctuations in price. I mean, if you're sitting here trying to make 2 handles, 3 handles, those types of trades, and that's your mechanism to do those types of things, I'm not going to sit here and try to shoot holes through that, because this is simply, I would never do that. Okay, I'm not interested in that type of trading. I'm interested in knowing where the market's going to reach to, and I teach my students to focus on that primarily in the early stages of their development. Depth of market, or level 2 data, requires you still to have an opinion, and that opinion may be incorrect, much like my opinion about the marketplace using my own concepts may be incorrect. Just like anybody else, we're still met with the challenge of knowing the first rule and goal that I teach my students, which is to know where you trust that the market is more likely to draw to, higher or lower, and not just for the sake of a few handles, because the depth of market may imply that there's more buyers or sellers at any given time. Just because there may be printing a depth of market ladder, which is what these things are called over here, these are ladders, there may be more orders stacking above marketplace or below the marketplace. And the idea generally is it's more likely, doesn't mean it's going to happen, but it's more likely that the market will gravitate towards where the larger stacking of orders. If it's more likely that it's going to go higher, then the justification should be made that the depth of market, the level 2 data, that ladder should show a lot more orders to the upside. And then when it gets there, it should eat into that and start eroding those orders. That to me is something that is synonymous with having a crutch. And that's not to be derogatory. I don't mean it in a sense that, nobody should use crutches, while they're learning or while they're using their model. If you feel like these things are helpful to you and it helps you focus on sticking to one side of the marketplace, if you have a bias, if you have a draw on liquidity that you feel is going to be booked for that particular trading session or that day, and this helps you stay focused on it, then there's nothing to be worried about. There's nothing wrong about that. In my opinion, and this is all it is, and you hopefully you can permit me to have my own opinion here. But the idea of using this stuff for the sole basis of whether you should be a buyer or seller is a little bit myopic, regardless of whether or not an XYZ trading firm or institution or bank or whatever has them on their terminals in their trading floor. It's irrelevant. The market still has that puzzle of where is it going to go, higher or lower. And when I teach my students to focus on where the most likely draw on liquidity is going to be, that's what you should be focusing on. Not all these little numbers in here on a footprint or over here worrying about is there more buyers or sellers above the marketplace, and it's likely to keep going up. And I watch a lot of YouTubers that use these types of tools over here, like the depth of market, the DOM. It's DOM, not dome. But the idea of using it, if you watch any YouTubers that have it on their charts or they're live streaming, or maybe they recorded their trades and they still have it on there, it doesn't appear, at least from my observations, it doesn't appear that it's all that helpful. Even when I can see the market is likely to go higher or lower, and I'm viewing them live streaming or watch something in the past when I can see what the market has done because I've either traded it or I can pull it up in chart form, I can see how they can be tricked into thinking, oh, I think it's going to go to this price because there's a lot of orders around that price. And I want you to think about what it is I'm teaching you. We're not looking at the necessity for these types of things to confirm anything, because my assumptions are you're allowing the market to be seen visually in chart form, and yes, through a time-based chart. There's a lot of advantages if you understand what it is I'm teaching. There's a lot of advantages to using a time-based chart, where some other individuals out there that don't have a subscription to the same view that I have may not like a time-based chart, and they have to augment that data and create a new format of a bar or a candle or something to that effect. So just know, going into this discussion, I will be stating why I am not a fan of this information or these tools. Do not let me change your mind if it feels like it helps you. If you're profitable and you feel comfortable using them, just because I may be your mentor, don't let me pry these things out of your hand. You may grow out of them on your own over time, or you may stick with them and it may be part of your repertoire. And there's nothing wrong with that as long as you're using them in a capacity that allows you to focus and allows you to trust your model. If that's what you're using them for, there's absolutely zero hindrances. There's nothing, I would never say anything adversely about it. But for someone to come out and say, this is how you read institutional order flow. No, you're reading order flow, but institutional order flow is not, this is not institutional order flow to me. This is this reporting numbers that can be spoofed. That means that they can pull those orders. That means that you may see them flash on the screen, but doesn't necessarily mean when price gets to it that those orders are still there. Many trading firms and quote unquote institutions institutions have been fined many, many times over. Some of them are repeat offenders. Some of these trolls I've had over the years are actually guilty of this. And they were penalized for spoofing, messing around with placing orders in to make it look like there's a more stronger interest to buy or sell a particular vehicle or instrument or market. And if there's an opening for manipulation to the data, and that can absolutely be done here, how can you really, in my opinion, this is my opinion now, I'm not trying to convince you to not use these things, but this is my opinion, how can you trust the basis of this data if it absolutely can be manipulated? If it can be manipulated to make it look like there is a fake buying interest where orders can be placed above the market price or below the market price, and the interpretation of that would be seen collectively in retail trading as there's a lot of orders below or below the marketplace, and the tendency is to trust that it's going to more likely go to where there are more orders, and that's not necessarily what happens. Now, I'm sure some of you that use this stuff that don't like me, you're going to come out with 10 different examples of where look where it worked. But I promise you, I can go on a live stream and show this stuff and it not working, where my stuff is absolutely running circles around it. So permit me to say that in this video, and I promise I won't be any more derogatory than that. But now from this point on, I want to kind of show you and compare and contrast what it is I'm trying to focus on in my teaching, so that way you're, as a student, you're looking at it the right way. And if you feel like, or you feel pressured by other people that will say you're not learning real order flow, no, we're not messing around with these things here. That's true, because it's not necessary. Because I want you to understand something. Listen to the name of this stuff here, okay? The footprint. That means you're looking at something that's already happened. How many orders were in this part of the candle, this part of the bar? Okay, it's already happened. Where have I ever told you to go into charts and say, here is how many buyers and sellers have been, so repeat what they've done or use that information? You never heard me say that. I'm always telling you to predict where price is going to go. And then where you think it's going to go, that draw on liquidity, above the marketplace or below the marketplace, it's going to go up to take out buy stops, or it's going to go up to reprice to an inefficiency, some kind of fair value gap or SIBI. Could be a volume imbalance. It could be a institutional order flow entry drill. It could be a consequent correction of a wick. There's very specific things that we're looking for, but not every single market at that time frame in that chart fractal, that portion of price that you're studying, is going to have every single thing that I have as a PD array, something that I teach you to focus on. But the ones that are actually there, you have to consider them and know what to do with them and navigate them. So I'm teaching you absolutely how to predict price, because how else are you going to use this information and trust it? I'll pose the question to you like this. If you are bearish on the marketplace, doesn't it make sense that if you're going to be using these tools, that you're expecting the depth of market to show a lot more orders below the marketplace, a lot more interest to draw price into lower prices, because your bias, your directional bias, your analysis, you are bullish or bearish. So you're going to go into this data looking for those things to justify what? Your analysis. So I don't go to the middleman. These are all middleman ideas to me. And it's helpful in the beginning if you don't know what you're doing and how to navigate price action, and you want to see the underpinnings of what the market's doing and how it books price. That's wonderful. But my PD arrays are always ahead of this. It's always ahead of it. Look at what I did this week with the analysis on the July 9th, 2023 video I did on Sunday before the market opened up. I told you exactly what we would be seeing. I told you what would be expected in terms of price delivery, and it delivered perfectly, flawlessly. No necessity on having any of this stuff here. So really, I want you to compare and contrast. If this is measuring minute by minute, second by second, real events of transactions, because that's what this all is showing you, is transactions. But just because there was a certain number of buyers or sellers at a particular price at any given time, and just because there are more orders above or below the market price in the DOM, has absolutely no bearing on future price. It has absolutely no bearing on the future direction of price. The market could stay stagnant and stay just consolidating. When this stuff was a big buzz, when I first started using it, when level 2 became a thing, and I'm old enough and I watched the transition from open outcry into electronic trading. When these tools were made available to us, everybody was clamoring to it because level 2, that was the thing. You were really informed if you had this information. Where's all the yachts? Where's all the billionaires and the millionaires? If it was going to make you institutional minded, where's all the rich people that came up out of nowhere using it? Right. So, not to discourage you, but when I say institutional order flow, it's not this. You know, you'll hear people say, ICT doesn't teach order flow. I don't teach this stuff because this stuff I have no faith in, and I know how to use it, but I completely cut it out of my analysis because I don't need it. You might need it. You may find helpfulness from it. It may allow you to feel closer to the marketplace. And if that's what you're feeling by doing it, then there's nothing wrong with that. Absolutely nothing wrong with it. Like I've already stated earlier, I have friends in this industry and I have students that use this stuff in conjunction with what I'm teaching, and they're profitable. So I'm not here to say this doesn't work. Okay. What I'm doing is I'm drawing a stark contrast between when I say institutional order flow, what am I talking about in contrast to this stuff here? That's what we're going to do, okay? So let's move on into the discussion here. We're going to look at a case study on NASDAQ, okay? And I'm going to spare you level 2 data because it's not required, it's not necessary, and I want you to think about how it is that I teach you and how I've shown a plethora of examples of before the fact, where the market's going to go, how it's going to get there. Not just here we are at point A, I believe it's going to maybe get up to point B. That's not what I say. I say this is where I think the draw of liquidity is. That means I'm cosigned. That's a directional bias. That means I have made my expectations known publicly beforehand. And it's not a 2 pip or 5 handle expectation. These are pretty considerate price moves. And I'm not utilizing anything that is classically lumped into order flow. Because folks that use that information, when I say I'm trading with institutional order flow, I'm seeing institutional order flow in price action. I'm going to cover that again today. I've done it in the past, but I want to present a little bit deeper presentation about it. And I want you to think about the lack of required tools that other people, other traders feel like they have to have. When I have nothing on my chart, it's simply a candlestick chart. And as long as I can see what time it is and where we are in the range, that's it. And that's all you need. So the number one thing is drawing liquidity. So I was bullish. Obviously, I mentioned that last Sunday. And today is July 16th, 2023 at the time of this recording. So last Sunday, July 9th, 2023, I had outlined my expectation of higher prices on E-mini S&P, NASDAQ, higher prices on Eurodollar, and lower prices on the dollar index. and it was a clean sweep. Everything delivered as I expected. They were not small moves, they were rather large. And I want to go into detail as to why I believed that NASDAQ would go higher. And I want you to take a look at the chart here, upper left-hand corner. This is the weekly chart. This right here, this candle right here, is a mitigation block. Now, I don't talk too much about it, but it is basically the opposite of a breaker, but they are still both mitigation in essence. Now, we have a high, a low, and a higher high. No, lower high. You see that? That low between it is a mitigation block. If this high here was taken out with a higher run here, then that would be a bearish breaker. Bearish breakers are much more stronger in terms of resistance than a mitigation block. A mitigation block can be traded through. So in terms of how I use mitigation blocks, I typically side with using them as targets more so than entry because they can be traded through. Breakers are kind of like, they're pretty formidable in the path of price action. It doesn't mean that they can't go through them. It doesn't mean I've never had a losing trade using a breaker, because I have. But mitigation blocks are better used for targeting purposes. I was using this one here with the expectation that the NASDAQ could try to gravitate towards that. If it were to go any higher, this small little fair value gap there, and obviously the buy side above it. So I have not called a high in the NASDAQ or ES. In fact, you've heard me emphatically state many times throughout the commentaries and or Twitter that I am not calling a high. And it's important for you not to try to do that too. Look how it just keeps drilling higher. It's grinding people down. Anybody that wants to sell short this market, and believe me, I'm in the opinion as well, that there's no justification for the markets to be where they are, at least for equities. Stocks should not be trading where they're at. But we have to trust order flow. What kind of order flow? The things I started to show you in the beginning of this presentation, I don't subscribe to those things. I don't have any faith in them.